My strategy that I've been using a lot here in 2021 it is a modified endowment contract policy. I have done talked about them and done more of them this year than probably the previous 20. And because it's a really unique strategy that allows us to participate in something like an index if you're using an IUL, but gives us access to the capital if we want or need it for something. So compared to a savings account that is, I mean, it's 0 and 0 is still 0. You know, yeah, you might be getting 0.25%, but it's taxable income. And a lot of people don't even recognize, hey, they're super excited. It's crazy to think about. People are excited about 1 or 1.5% interest, and they're ecstatic. They're not just excited. But then, especially if they're a top tax bracket taxpayer, you remind them that 40 to 45 cents of that is going to the government. They're like, oh yeah, I forgot about that. And so it's just a way to build a different component. Even if they're under 59.5 in a MEC, they're paying a penalty, but it's still better than what you can get at the bank.
Hey, Matt, I think that a tax expert like you using a MEC would be surprising to all the people dialing in today. In the college planning niche, we've used MECs frequently because of the financial aid formula. So if somebody suddenly gets money or they need to vanish an asset legally for financial aid eligibility purposes, we use it. But I think that it would be super helpful for you to just walk through the rationale. Why would you recommend to anybody that they use a modified endowment contract? And we go back to the 10-minute lesson on life insurance. So we're not going just up to that ceiling for a maximum efficient contract. We're piercing the ceiling, creating a modified endowment contract. But why? I want to hear this the way you would explain it to a business owner client for the benefit of everybody that's joined us today.
Yeah, absolutely. So I just pulled up and shared my screen. I've just got the whiteboard on the screen. I'm going to use some higher than normal numbers just to round it and keep this demonstration really, really simple. Number one, a MEC. So when you use a MEC, the way that I'm talking about right now is we're putting the maximum amount over the limit. We want 100% of the cash value, or as close to that as possible, available in the first year. So you're going to exceed the MEC limit because the IRS is not going to allow you to do that. So let's just say somebody has $100,000 sitting in a bank account that they want to have accessible. They are worried about inflation, but they don't want to lose the money. So right now they've gone out, let's just, we've got 100K over here. They've gone out and let's say they can get 2% in a money market account. And that's what they're doing or a CD, they bought a long-term CD. So we've got a 2% return opportunity, and we're going to assume a 50% tax rate, again, to keep these numbers very, very simple. So if we've got 50% taxes on a 2% return, we're actually getting 1% return after taxes. Now, again, this is where you can have a lot of fun with some of these demonstrations, and we'll learn some of this at Cal College. We'll have more of this going on in some of the courses next year. But in the taxable account module inside of spending game, and then also the buy term invest the difference module, and I'll show you guys those modules here when we're done just to accentuate this conversation. I use those all the time when we're talking about MECs, because nobody connects the dots of what we're about to look at right here. So if we've got 100K and we've got a 2% return to the bank and a 50% tax bracket, we're basically getting $1,000 in return at the end of the day after tax. So in a MEC space, so let's say we take the same 100K and we have the opportunity. Now I use MECs primarily in IUL. So I am going into a 0% floor MEC and up to a 7 to 10% cap MEC, depending on who I go with. So let's just use 5% as a contrary item, and my drawing skills are a little lacking, so I apologize. I have my laptop today, but I don't have my mouse, and I hate with a passion trying to draw on the pad mouse on the laptops. It drives me insane. So bear with me on my drawing skills. So this is 5% here. If you can see that, we'll actually do this. I can redo it a little bit better. So that means I have the ability to earn 5% potentially inside of an IUL. Now it could be 0. So you have to show the client that, at least I believe you do. It could be 2, it could be 5, it could be 8. One of the strategies we use, it's an uncapped index. So now they haven't ever performed or produced more than like 10 or 12% on the uncapped option, but 10 or 12% is phenomenal. But again, to keep this simple, let's just say it's 5 compared to 2. So 50% taxes again. Now there's a little catch here because 50%, if I'm on normal over here, in a MEC, I'm going to assume this person is under 59 and a half. So this is a tax rule to remember, that if you're in a MEC policy and you're not 59 and a half, you have to pay taxes on the profits and you have to pay a 10% penalty. It becomes just like a retirement account at that point. It's an early distribution if you use the money. However, you don't have to use the money. What often happens, or what I see with business owners, is they're sitting on this capital right here just in case. And they don't often ever use it. So even if they do use it, or even if they want to use it for an opportunity, let's say that opportunity doesn't present itself for 3 years. Well, if we don't touch the money, my 5%, let's just use 5% simple interest, okay, to keep it real simple on the whiteboard. That means 3 years from now, I've got 115,000 in the account and I haven't paid any taxes yet. I'm deferring those taxes down the road because I'm not accessing the money. When I do access the money, I'm going to have to pay taxes plus a 10% penalty. You'll quickly see that, again, especially on a simple interest basis, over here after 3 years, we're looking at $3,000 after tax, simple interest. Over here, let's say we accessed the full $15,000 gain and we paid taxes at 60%. So I'm looking at $5,500-ish over here after tax. I'm $2,500 ahead. This is a pure safe capital strategy to do something to improve what I'm getting. And then if you get in, there's even more components to this, but this is the basic bare bones component of the MEC conversation. That and then if you get, let's say we're wrong, let's say the stock market keeps charging for the next 2 years, and this is where an IUL is a little bit stronger in the MEC space than say a whole life policy, in my opinion. That's just an opinion statement, for a couple reasons. It gives us some upside potential that we don't have in whole life, and most whole life MECs, you're going to be underwater for 12 to 24 months from what you put in, where in an IUL, you're underwater, but you're barely underwater. You have really true premium value in a MEC if it's designed properly, and then you just have to pay the fees. The fees in a MEC IUL can range anywhere from 1 to 2% depending on health. So in a 0 year, that's the disclosure part that you got to make sure the client understands. We can go backwards in a 0 index year in a MEC by the fees, but the fees is your only true risk in that conversation in terms of going backwards. And the last thing, and I'll talk more about this at Cal College in much greater detail, the way an index works, you don't get any policy credits until the 12th month anniversary from when you bought the contract. So if you were to do this now, you actually have access to all of that money via loan from the insurance company with no tax consequences before your anniversary because you haven't made any profits yet. So again, there's some timing and some strategy involved for those that are looking to park capital and have it accessible for opportunities to use MECs and be protecting at the same time.